In this video, I'm gonna break down exactly how you can pay off your mortgage in the next 5 to 10 years. You don't have to change any of your current financial habits. You don't have to be rich, and you don't have to live off rice and beans in order to make this work for you. All you have to do is use a different type of loan to finance your home that most people don't know about. When I first introduced this strategy to whether it's real estate agents, mortgage brokers, financial planners, accountants, the general public as a whole, the American public as a whole, 99.9% of them have never heard of this strategy. It sounds too good to be true, and that's exactly what the bankers on Wall Street want you to think. Because if you swap your mortgage for a mortgage-free HELOC, they're going to lose out on a ton of revenue, okay? So I'm going to show you how this works. You're going to pay off in about 5 to 10 years. You're going to save a ton of money in interest. And on top of that, the mortgage-free life system as a whole can repurpose your mortgage payment and turn it into tax-free retirement income. In this video, I'm just going to be breaking down how we actually pay off the home. So the first thing that we need to understand is the loan itself, all right? So a mortgage-free life HELOC is an open-ended loan. Money can flow in and money can flow out. This is a very important principle that we need to understand in order to understand the strategy as a whole. Now, on top of that, the interest is calculated based off the average daily balance. What this means is that, let's say there's 30 days in a month, and we take all the balances throughout those 30 days, and then we calculate the average. The bank multiplies that average by the interest rate. That's our interest payment for the month. It's an interest-only loan. So if we know that money can flow in and out, and we know that money or that interest is getting calculated based off the average daily balance, the question becomes, how do we keep our balance as low as possible for as many days as possible so we pay as little interest as possible? Which brings us to the fact that it's an open-ended loan. We park our paycheck inside the loan, our expenses come out, whatever's left over is paying down the principal balance. It's really that simple. Let me show you what it looks like. So right now, I would assume that you spend money like this. This is how money flows through your life. So you get income from your job, whether that's W-2, 1099, maybe you're a business owner, and it flows into the checking. From here, your expenses flow out, okay? So this is things like your mortgage payment, kids, cars, etc., okay? So this is what it probably looks like for you. The difference with the mortgage-free life system compared to this is we're adding in the mortgage-free HELOC right here, okay? The MFL HELOC. Now, one thing I forgot to mention when talking about this, whatever you don't spend, that is just going to sit in your bank account. It's not really doing anything for you there. It's not really working for you there, okay? So we use this MFL HELOC to pay off 100% of the mortgage. There is no more mortgage. Now we swap that for an interest-only payment, okay? So it's just an interest payment. We don't actually just want to make only the interest payment because then you never pay down the loan. The home loan would never be paid off. So we want to see how to use this effectively. So what we do here, let's say your balance was at, I don't know, 200,000 or so. Your income comes in, goes into the checking, and then it presses down and it goes into this HELOC, pressing down on the balance. So it took it from, let's say, 200 to now it's at 190. Let's say 10K a month of income is going in. The reason we do this is because it's an open-ended loan calculating interest based off the average daily balance. So as that money comes in, it presses down, reducing how much we're going to get charged in interest. Our expenses, however, have to come up and out, which is going to raise this. Let's say our expenses are 5,000. Okay, so that's going to raise it from 190 to 195. So this is our ending balance for the month. Now we're going to continue this process every single month until the home's paid off. So let's say it went from 195 to 185. because again, that 10,000 of income comes in, and then it goes up to 190 because the 5K of expenses go out, and then it goes down to 180, and then it goes up to 185. We rinse and repeat until the home is paid off. It's a much more efficient way to pay off a home. Your money is now stored in the equity of your home instead of in a bank account. And if you want to know why we do that, well, very simply, in the bank, right? Let's draw a bank real quick. Your money is going to earn 0.5%, maybe 5%. But in the HELOC, in the value of your home, it's not only going to pay down the principal, offset the interest, it's also going to appreciate with the value of your home. Now, let's move over to the requirements and how we actually make a strategy like this work. So, I just moved over because I don't know if you could see me on that side. It probably just look weird. I just walk over there and walk back. Anyway, there's 3 main requirements. The first is going to be the ratio requirement. That's what this entire strategy revolves around. If you don't meet the ratio requirement, the strategy is just not going to work for you. Starts at about 25%. Now, this is the gap between income and expenses. So when you hear me talk about the income gap, this is what I'm referring to. So let's say you have $10,000 a month coming in and $5,000 a month going out. Well, you would have a $5,000 a month income gap. This $5,000 normally would sit in the bank, but instead we're using it to pay down the balance of our home. If you don't meet this, the minimum 25% strategy will not work for you. Something to add is that the higher your balance with the lower the rate, the larger the gap needs to be. The higher the rate, the lower the balance, the gap doesn't need to be as big. We like to see about 25% minimum in order to make this work for you. 10 to 20% equity in the home is the second requirement. Because this mortgage-free life HELOC is paying off the mortgage, it's not just going to be the equity that you currently have. So a lot of people think, well, how am I going to get a HELOC big enough to pay off my mortgage if I only have 25% equity in the home? That's not what I'm talking about. I'm talking about replacing your mortgage with the mortgage-free life HELOC. So you only need about 10 to 20%. In some states, it's going to be 20%. In the majority of states, it's going to be 10%. And then sometimes on rental properties, because this does work on rental properties, it could be 25 to 30%. That's what it's currently at. And that might change, but that's what it's currently at. And then finally, you need good credit, okay? 700 or above. Typically, when you go to get a loan, you need good credit in order to get the best terms, okay? So without the ratio requirement, forget all this. It's not going to work for you. But if you follow the system as we've laid out here, an open-ended loan that's calculating interest based off the average daily balance, you're going to be able to pay off your home in about 5 to 10 years. That's part 1 of the mortgage-free life system. Part 2 of the mortgage-free life system is going to allow you to take what was your mortgage payment and turn that into tax-free retirement income. And if you want to learn more about that, I'm going to make some videos on that coming up here soon. So just stay tuned, but appreciate you watching. If you have any questions or if you want to see how this might work for you and your family, all you need to do is look in the description below. I'm going to have a link to a little bit more in-depth of a training that not only goes over this, but also shows you how we turn the mortgage into that tax-free retirement income. So make sure you go watch that, and then it'll ask if you want to book a call with either myself or someone on my team to see what this would look like, to see what your numbers would look like, how much time you can save, how fast your home's paid off, how much interest you can save, and how much tax-free retirement income you can generate. Go down, look at the link in the description, check out the training, and I'll see you there.